Hello everyone. Welcome to the Stock Minds web channel. OSCR Health, NYSE, OSCR, has emerged as a notable player in the health insurance sector, leveraging technology to enhance healthcare accessibility and affordability. Despite facing challenges since its IPO, the company's recent financial performance indicates a promising turnaround. In this video, we will dive into OSCR Health recent earnings, stock performance and valuation, growth potential, and the risks investors should consider. About OSCR Health. Founded in 2012 by Mario Schlosser, Kevin Nazemi, and Joshua Kushner, OSCR Health is headquartered in New York City. The company aims to revolutionize the health insurance industry by integrating technology into its services. OSCR offers health plans in the individual, small group, and Medicare Advantage markets, operating across 18 states with over 2 million members. Its services include telemedicine, transparent claims pricing, and incentives for maintaining health, such as cash rewards for meeting fitness goals. OSCR Health financial performance. OSCR Health delivered a strong financial performance in Q1 2025, signaling substantial operational improvement and momentum in its business growth. The company reported quarterly revenue of $3.04 billion, a 42.2% increase compared to $2.14 billion in Q1 2024. Earnings per share, EPS, rose to 92 cents, up 47.21% from 62 cents in the same quarter last year, reflecting greater efficiency and profitability. On a trailing 12 months TTM basis, OSCR's revenue climbed to $10.08 billion, a robust 54.26% year-over-year increase from $6.53 billion. EPS over the TTM also improved significantly, reaching 46 cents, a substantial turnaround from the negative 24 cents recorded a year earlier, an impressive growth of 229.09%. Free cash flow per share, TTM, surged to $4.43 from minus 34 cents in the prior year, an extraordinary improvement. Profitability margins further reinforce the positive trend, with a gross profit margin of 20.28%, a net profit margin of 1.22%, and a free cash flow margin of 11.82%. These figures suggest that OSCR Health is not only growing rapidly but also managing its resources efficiently. The company's return on assets stands at 2.06%, and return on equity is 10.47%. Additionally, a conservative debt-to-equity ratio of 0.27 highlights a healthy balance sheet with limited reliance on debt financing. Over the past 5 years, OSCR Health has increased its revenue at a 114.8% CAGR, while net income started to turn positive in 2024 and is continuing to grow. Free cash flow is also growing but has fluctuated inconsistently. OSCR Health 2025 Financial Forecast. Looking ahead, analysts project OSCR to continue the growth, forecasting revenue to reach $11.24 billion in 2025, a 22.5% increase from 2024's $9.17 billion. EPS is expected to grow significantly to 77 cents in 2025, up from 10 cents in 2024, representing a staggering 665.71% projected growth. However, despite these strong fundamentals, analysts currently assign a sell rating on the stock with a price target of $13.83, suggesting a potential downside of 16% from current levels. I think analysts are very conservative and cautious about OSCR because of the potential expiration of enhanced exchange subsidies, which are set to lapse on January 1, 2026. These subsidies are crucial to OSCR Health's earnings, and their discontinuation could significantly impact the company's financial performance. But, in my personal opinion, I think OSCR Health will manage it. OSCR Stock Price Performance and Valuation. At the time this video is created, OSCR Health's stock is trading at $16.47 per share, reflecting a 25.1% decline over the past year. This performance significantly lags behind the S&P 500, which gained 11.8% in the same period. Since its initial public offering, IPO, in March 2021, The stock has fallen by 46.8%, while the S&P 500 has climbed 54.5%, highlighting a substantial underperformance relative to the broader market. However, because of this historical weakness, Oscar Health's current valuation metrics become undervalued, particularly in light of its accelerating growth and improving financials. On the valuation side, the company's price-to-sales (TTM) ratio stands at just 0.41, with a forward price-to-sales ratio of 0.38, indicating the market is pricing the company at a low multiple of its revenue. Its price-to-earnings (TTM) ratio is 36.27, and the forward PE ratio is expected to improve to 25.64 as earnings increase. Notably, the price-to-free cash flow (TTM) ratio is just 3.52, which is very low and making the stock very attractive because of its low valuation compared to the generated free cash flow. Based on FinChat data, if we look at the forward PS ratio from 2022 until now, it is currently trading at above the average, but it's still at a low value below 1 and projected to grow this year, while EPS also projected to grow. These figures, when considered alongside Oscar Health's rapid revenue growth, positive earnings trajectory, and expanding free cash flow, suggest that the stock may present an attractive opportunity for investors seeking undervalued growth plays in the healthcare sector. Oscar Health growth potential. Oscar Health business growth are driven by several factors. 1. Membership growth and market expansion. Oscar Health demonstrated robust membership growth in Q1 2025, with effectuated members reaching 2 million, a 41% year-over-year increase driven by strong retention rates, new customer acquisition, and high-performing condition-specific health plans addressing specialized market demands. The individual and small group segment remained the primary growth engine, expanding 46% to 2.02 million members compared to Q1 2024. This expansion reflects Oscar's technological capabilities in data analytics and AI-driven care coordination, combined with personalized member experiences that differentiate its offerings in competitive insurance markets. The company's strategic focus on tailored health solutions and virtual care accessibility continues to drive market penetration while maintaining competitive pricing structures across its expanding service areas. 2. Strategic growth initiatives. Oscar Health's growth strategy encompasses several key initiatives that position the company for continued expansion. The company's strategic focus on technology and innovation has been instrumental in driving its rapid growth in the individual insurance market. By leveraging artificial intelligence and data science to analyze individual user health data, Oscar can provide more personalized and effective healthcare services. The company's virtual care capabilities represent another significant growth driver. Oscar Health was an early adopter of telemedicine services, which have seen accelerated demand following the pandemic. The company's 24/7 virtual care platform enables members to easily consult with doctors online, enhancing convenience and satisfaction while potentially reducing costs. 3. Partnerships and market opportunities. Oscar Health's strategic partnerships have played a crucial role in its growth trajectory. Collaborations with health insurance giants like Cigna and Cleveland Clinic have enabled the company to build broader healthcare networks and offer competitive plans to small businesses and individuals. These partnerships allow Oscar to expand its customer base, strengthen its medical network, increase competitiveness, and improve cost efficiency. The company also sees growth opportunities arising from market dynamics. During its earnings call, Oscar's management indicated that Aetna's exit from the Individual Affordable Care Act (ACA) marketplace in 2026 presents a significant opportunity for Oscar Health. This exit will leave around 1 million members seeking new coverage, and Oscar, with significant overlap in Aetna's markets, sees a chance to attract these members with competitive pricing and tailored products. The company plans to maintain competitive pricing while remaining disciplined in underwriting and risk adjustment practices. Risks to consider. While Oscar Health looks undervalued, investors should be mindful for potential risks. 1. Regulatory and political risks. A major risk stems from Oscar Health's reliance on the Affordable Care Act (ACA) subsidies, which have been a substantial part of its business growth in recent years. and Enhanced Subsidies for Affordable Care Act, ACA, are set to expire at the end of 2025. The ACA has faced political opposition, notably from former President Trump, who attempted to repeal these subsidies in 2017. Although those efforts failed, future changes or repeal of the ACA or its subsidies could severely disrupt Oscar Health's business model. If subsidies were removed or replaced, Oscar would need to pivot heavily towards the individual coverage health reimbursement arrangement, ICHRA market, which could be challenging for a smaller company and potentially disastrous for its growth prospects. 2. Industry competition. Oscar faces competition from major national insurers such as United Health Group, Anthem, Cigna, Aetna, ACVS Health subsidiary, Humana, and Molina Healthcare. These players have extensive provider networks, deep financial resources, and diversified product portfolios that cover individual, group, and government-sponsored plans. For example, United Health Group is the largest insurer in the U.S., with broad service offerings and a vast provider network, making it a formidable competitor for Oscar. 3. Reliance on reinsurance agreements. Oscar Health uses quota-share reinsurance to meet capital and surplus requirements and mitigate downside risk on medical claims. If regulators do not approve these agreements, or if the company cannot negotiate favorable renewals, its capital position could be negatively impacted, potentially leading to non-compliance with regulatory requirements and financial strain. Conclusion: Oscar Health's impressive Q1 2025 results, coupled with its innovative approach to health insurance, suggest a company on the rise. While the stock has underperformed since its IPO, current valuation metrics and growth prospects indicate potential for investors. As with any investment, it's essential to consider the associated risks, but Oscar Health's trajectory makes it a compelling option for those seeking exposure to the evolving healthcare sector. But remember, this is not a financial advice. What do you think about Oscar Health? Are you buying, holding, or passing? Drop your thoughts in the comments below. If you found this video helpful, please make sure to like, subscribe, and hit the bell so you don't miss my next stock analysis. Thanks for watching and see you in the next one.